What up? What up? Hey, welcome back to the Real Estate Playbook. My name's Andrew, and today we're going to jump into how to use seller concessions. Now, if you've watched my other videos, you probably know that the cash to close is ultimately the funds that you need to have to purchase a home. But inside of the cash to close, you have your down payment and then you have your closing cost. And I'm sure you hear a lot of buzz when you're talking to realtors and lenders and et cetera, or in the news. When you hear people say there's an opportunity to buy the rate down or get seller credits or essentially get money from the seller to pay for your closing costs. And today I want to talk about how do you spend that money, right? Because if the seller is giving you money, it's our job as lenders to show you what's the best way to use your money, right? And I thought, what better way to show you than to use a real live example. So I'm just going to get in the whiteboard here and do some math and art and go into the details here and just kind of show you maybe some things that you can do outside of just buying the rate down to help you save some money. So an example that I have right now where I'm helping a young man purchase a home. I'm going to give you an example here. Example. He is purchasing a $370,000 townhome. Now, on a conventional loan, when you're trying to figure out how much seller credits you can use, the max is 3%. So 3% of $370,000 is the maximum amount of money you can get from the seller to buy the rate down, pay for closing costs, and some other things that I'm going to show you. So in this situation, their max credits, his max credits is $11,100. If you take 3% of this on a conventional loan, 3% of 370, you get 11,100. That's the max amount of credits you can use. Now, if you're on an FHA loan, you can go up to 6%. But for this borrower, a conventional loan is much better for him. It's going to be a way better bang for his buck. So we're going conventional. So that's how much seller credits we can use. And in his situation, he got the max that he could get. Shout out to Michael, his realtor, who helped him get all this money. Michael did an amazing job getting him the max amount of credits you can get. So that's what we've got, which is going best case scenario. Now, the first thing I always tell people when you have seller credits is let's pay for the things that you already have. A lot of people say, you need to use these credits to buy the rate down, which, yes, that's something you can do. But I'm just going to address some things that you can use that you can use 11,100 for to pay for that you're already going to have. Because, right, when you're buying a home, you're going to have your closing costs. And you're already going to have some things to pay for before you buy the rate down further, if that's what you're going to do. First, you're already going to have bank fees. This is the origination, the processing, the underwriting, the closing, right? This is what the lender's charging you. So before you buy the rate down, right? Before you do that, you're already going to have bank fees. This is just the normal fees that go into a loan. You're going to have bank fees. You're going to have third-party fees. This is like your appraisal, the credit report, title insurance, recording with the county, things of that nature. These are also third-party fees that you're going to have. And then lastly, in our closing cost bucket, you're going to have prepaid expenses. So this is when you're prepaying your property taxes, prepaying your homeowner's insurance, and then also the interest from when you close throughout the rest of the month. Okay, these are all variable things that can change, but these are the closing costs that you have to pay for, that you can pay for with this 11,000. So I always tell people before you buy their rate down, like before you even do that, use this money to lower your closing costs. So that's the first thing I would do, because this is money that that's specifically for paying these things down. So hopefully you don't have to come out of pocket and pay for these, right? There's no point to me. Doesn't make a lot of sense to buy the rate down and use this for the rate when you are going to be left with these things out of pocket. Short term, you're not helping yourself save money. So I guess the detail here is we're using some of this 11,100 to go towards here. Okay. Now, in this situation, we have money left over. Okay, we've paid for all these for this client. We've paid for all these fees. So now we're going to say, well, what do we do with the rest, right? We want to use all of it, because if you don't use all of it, it just goes back to the seller. And the next thing that I would suggest is inside of your prepaid expenses is your prepaid interest. Okay. This is interest you're paying on the loan from whenever you close throughout the rest of the month. So if you can and you have extra money, what I always tell people is try to push your closing as early in the month as you can, because you're going to pay interest from whenever you close through the rest of the month. And the earlier you close, the more interest you're going to collect. But we want to do that because in the first couple of mortgage payments you have, unfortunately, it's mainly interest. So if we can bump it as soon, sooner in the month, you can essentially get a free mortgage payment. For this client, he's gonna be closing the first of the month in April. So we're gonna collect interest from April 1st all the way through April 31st. His closing costs are going up, but we're using this money to pay for that. So he's essentially getting a free mortgage payment. Yes, for all the people out there that are going to nitpick me, okay, yes, there is a little bit of principal you are paying for, but a majority of your first payment is interest. So if you can move your closing date up sooner in the month, you can do that. That's what I would do. Now, sometimes you can't do that because the seller and the buyer, whatever, it's timing wise, you can't with when they need to sell the home. But if you can work it out that way, that's a great way to use up money that you have available. Now, after that, okay, let me just put some numbers here. One is I would use all the money you have here. Two is I would, move the closing date up sooner in the month so you can get more prepaid interest to basically defer that payment and help yourself get essentially a free mortgage payment. Now, number three, and you can't always do this, depends on where you're buying, but use your closing cost to pay for HOA dues. Okay. Where I'm at in Utah, HOAs are super common. This client, he's purchasing in a townhome, so he has HOA dues. And this HOA, they're going to let us pay up to 1 year in advance of his HOA dues. And I ran the numbers for him to show him how much he would save by paying the HOA dues down rather than paying down the rate. And he's going to help him save an extra like $85 a month. Okay. By doing this, he's saving his HOA is $108 a month, which is pretty conservative out here in Utah, but still we're using this money that we still have to pay towards the HOA. So the first year, he won't have any HOA payments. Now, lastly, this is where if you still have money left over, this is where another thing you could do is a home warranty. You could use this seller paid closing cost to get a home warranty, right? If you have depends how much you have left over, you always do a 1 year home warranty, but you could go in addition to 2 years or maybe even 3 years. Like there's options there. That's another way to use up credits without directly resorting to the rate buy down. And now lastly, yes, if you still have money left over, you can do the rate buy down. And guys, I'm not suggesting that you don't do a rate buy down. I'm just showing you, several different things you can do to use the money that you have. Because when you start to do the math, you'll figure out that it's very expensive to buy the rate down. And a lot of times people are spending three, four, five. I mean, some people are paying $8,000, $9,000 to buy the rate down, like 0.5% or not even 0.5%. And depending on your loan amount and how that's structured, a lot of times you're only saving, 50, $60 a month. So you're spending a huge amount of money to, marginally save, where all of these things have way bigger bangs for your buck, right? So just recapping here, if you have the money, let's pay off the things you already are going to have to pay for. There shouldn't be a need to bring in extra money for closing costs if you have it to pay for already, right? So in this situation for this gentleman, the only cash he's bringing in is his down payment, his equity in his home. He's not paying for any closing costs. So let's wipe out those things first. Then next, a way to increase your closing costs is to, close sooner in the month, right? You can collect more interest, more prepaid interest to help them and basically defer the payment, right? So for him, if he's closing in April, he's not going to have a payment in April, won't have a payment in May. His first payment will be in June. So from when he purchases his home, he's not going to have a mortgage payment for 2 months because we move his closing as soon as the month is possible. So he's essentially getting a free payment there from us. That's a great way to use it up. Next for him, because he's going to live in an HOA, we're prepaying up to a year in HOA dues. Some HOA communities will actually let you pay more than a year. You will just have to check and see. Okay. Every HOA has their own rules, but for him, we're going to prepay up to 1 year of the HOA, right? For him, that's $1,300 he's saving a year, roughly on that. That's a big chunk of change saving. Okay, next, you could do a home warranty if you don't already have one, right? You could use a home warranty. You could get an extended home warranty to use those funds. And then lastly, yes, you can do a rate buy down. So for him, this was the progression we followed for him because for him, it made way more sense to use the money this way than to immediately jump to buying the rate down. Now, I do understand in some situations you have to buy the rate down to help people qualify, but we're looking at this from a different angle and we're just overall looking at what can you use the money for to help save you money. So this is a real scenario that I'm doing for a homeowner right now. I thought it'd be helpful to share with you. Maybe comment or reach out directly and we can go through your scenario individually, but just want to share this with you. Hopefully it brings value to you. If you're a homeowner, this is some stuff you can use, or if you're a young agent or an agent in general, these are some tactics you can use to help your buyers just so they're allocating their money, where it makes the biggest difference. So appreciate you watching. I will see you on the flip side.